Have you ever wondered how banks manage all the risks they face every day? Like, how do they know what investments to make and which ones to avoid? It is really a complex process called risk management, and it is a big part of what investment banks do. Hello everyone, and welcome to this video on risk management in investment banking by Intellipaat. Basically, risk management is about identifying and assessing potential risks and then taking steps to minimize or mitigate those risks. Investment banks have to deal with all sorts of risks, from market fluctuations to credit defaults to operational issues. It's a challenging but important part of the banking industry, and it helps ensure that banks can continue to operate successfully and protect their clients' investments. So stay till the end to learn more about risk management in investment banking. And with that being said, here is a look at the agenda for this video. First, we'll talk about what is risk management. Then we'll look at the types of risks. Then we're going to talk about risk management techniques. Then we'll look at regulatory frameworks. Then we'll talk about the role of technology. Then we're going to look at some case studies. And with that, we'll conclude. But before we begin, make sure you subscribe to our YouTube channel and hit the bell icon to receive regular updates from us.
So let us begin by understanding what is risk management. Risk management in investment banking refers to the process of identifying, assessing, and controlling various types of risks that are inherent in the business of investment banking. The primary objective of risk management is to minimize the negative impact of risk events on the firm's financial performance and reputation. Investment banks are exposed to a range of risks, including market risk, credit risk, operational risk, liquidity risk, and legal and regulatory risk. These risks can arise from a variety of sources, such as changes in economic conditions, fluctuation in asset prices, and operational failures or errors. To manage these risks, investment banks employ a range of risk management techniques and tools such as financial modeling, stress testing, hedging, diversification, and risk limits. These tools help investment banks to identify potential risks, measure the impact of these risks, and implement strategies to mitigate them. Effective risk management is crucial for the long-term success and stability of investment banks, as it helps to ensure that the bank can weather adverse events and remain profitable even in challenging market conditions. Now let us look at some types of risks. Starting with market risk. Market risk refers to the potential losses that investment banks may face due to changes in market conditions such as fluctuations in interest rates, currency exchange rates, or asset prices. Investment banks typically manage market risk by using various hedging strategies such as derivatives, futures, or options to protect their positions against adverse market movements. Moving on to credit risk. Credit risk is the risk of loss that investment banks face if their borrowers or counterparties default on their obligations. Credit risk management involves assessing the creditworthiness of borrowers and counterparties, setting credit limits, and monitoring credit exposures. Investment banks also use various risk mitigation techniques such as collateral requirements and credit derivatives to manage credit risk. Third is operational risk. Operational risk is the risk of loss that investment banks face due to failures or errors in their internal processes, systems, or personnel. Operational risk management involves identifying potential sources of operational risk, implementing controls and procedures to mitigate these risks, and monitoring the effectiveness of these controls. Investment banks also conduct regular stress testing to identify potential operational risks and ensure their preparedness to handle them. Fourth is liquidity risk. Liquidity risk is the risk of loss that investment banks face due to their inability to meet their financial obligations when they come due. Liquidity risk management involves maintaining adequate levels of liquidity to meet financial obligations, managing funding sources, and monitoring liquidity risk exposures. Investment banks also conduct regular stress testing to assess their liquidity risk and to ensure preparedness to manage liquidity crises. Fifth is legal and regulatory risk. Legal and regulatory risk is the risk of loss that investment banks face due to non-compliance with legal or regulatory requirements or changes in laws and regulations. Legal and regulatory risk management involves staying up to date with changes in laws and regulations, ensuring compliance with these requirements, and implementing procedures to mitigate legal and regulatory risks. Now we'll look at some of the risk management techniques. Starting with financial modeling. Financial modeling involves creating mathematical models to predict the impact of various risk events on an investment bank's financial performance. Investment banks use financial modeling to assess the potential risks and rewards of different investment strategies, evaluate the impact of market movements, and identify opportunities to hedge risk exposures. Second is stress testing. Stress testing involves simulating extreme scenarios such as market crashes or economic downturns to evaluate the potential impact of these events on the investment bank's financial performance. Stress testing helps investment banks to identify potential vulnerabilities, measure the effectiveness of their risk management strategies, and assess their preparedness to manage risk events. Third is hedging. Hedging involves using financial instruments such as derivatives or futures contracts to offset potential losses from adverse market movements. Investment banks use hedging to manage market risk, credit risk, and other types of risks. Fourth on the list is diversification. Diversification involves investing in a variety of assets to reduce risk exposure. Investment banks use diversification to manage market risk and credit risk by investing in a range of asset classes such as equities, fixed income securities, and derivatives. Finally, risk limits. Risk limits involve setting specific limits on the amount of risk that investment banks are willing to take on. Investment banks use risk limits to manage risk exposures and ensure that they are not exposed to excessive levels of risk. Now we'll look at the regulatory frameworks. Regulatory frameworks in the context of risk management in investment banking refer to the rules and guidelines and policies established by government regulatory bodies to ensure that investment banks operate in a safe, fair, and transparent manner. Investment banks operate in a highly regulated environment, and there are a number of regulatory frameworks in place to ensure that they comply with a range of legal and ethical requirements. These frameworks are designed to protect investors, prevent fraud, and promote market stability. Examples of regulatory frameworks that impact risk management in investment banking include Basel III. Basel III is a set of global regulatory standards that require banks to maintain higher levels of capital and liquidity to protect against financial risks. Basel III includes requirements related to risk-weighted assets, capital adequacy ratios, and liquidity coverage ratios. Second is Dodd-Frank. Dodd-Frank is a set of US regulatory reforms that were introduced in the wake of the 2008 financial crisis. Dodd-Frank includes various provisions related to risk management, such as the establishment of the Financial Stability Oversight Council to monitor systemic risks, and the implementation of the stress testing and capital planning requirements for banks, and the creation of Consumer Financial Protection Bureau to protect consumers from abusive financial practices. Finally, MIFID. It is a set of European Union regulations that aim to improve investor protection and transparency in financial markets. It includes requirements related to the disclosure of fees and charges, the separation of research and execution services, and the reporting of transactions to regulators. Investment banks must comply with these regulations, which can have a significant impact on their risk management practices. Compliance with these regulations requires investment banks to have robust risk management frameworks in place, including risk management policies and procedures, risk monitoring and reporting systems, and risk governance structures. Now we'll look at the role of technology in risk management. Starting with advanced analytics. Investment banks use advanced analytics such as machine learning, artificial intelligence, and data analytics to analyze large amounts of data and identify potential risks. These technologies can help investment banks to identify trends and patterns that may be difficult to detect using traditional risk management techniques. Second is machine learning. Machine learning involves training computer algorithms to recognize patterns in data and make predictions based on those patterns. Investment banks use machine learning to analyze vast amounts of data such as market data, credit data, and operational data to identify potential risks and develop risk management strategies. Other technologies. Investment banks also use other technologies such as blockchain, cloud computing, and robotic process automation to improve their risk management practices. For example, blockchain can be used to create secure and transparent record-keeping systems, while cloud computing can provide cost-effective and scalable data storage solutions. Investment banks must ensure that they have the necessary technological infrastructure and expertise to effectively use these technologies in their risk management practices. Now we'll look at some of the case studies. Starting with managing risk during the 2008 financial crisis, investment banks faced significant challenges during the 2008 financial crisis, including market turmoil, credit losses, and liquidity crisis. Investment banks that had robust risk management frameworks in place were better equipped to weather the crisis, while those that lacked effective risk management practices suffered significant losses and in some cases went bankrupt. Moving on to the second case, that is managing risk during the COVID-19 pandemic. The COVID-19 pandemic has created significant challenges for investment banks, including market volatility, credit risk, and operational disruptions. Investment banks have had to quickly adapt their risk management practices to address these challenges, such as increasing their liquidity buffers, adjusting their credit risk models, and implementing remote working arrangements to maintain operational resilience. Case studies can provide valuable insights to the practical application of risk management techniques and frameworks in real world scenarios. By studying these cases, investment banks can learn from past experiences and improve their risk management practices to better manage future risks. In conclusion, risk management is a critical function in investment banking that helps banks identify, assess, and mitigate the various risks they face on a daily basis. It is a complex and challenging process that requires investment banks to employ a range of tools and techniques to manage risks effectively. From diversifying their portfolios to implementing risk limits and hedging strategies, investment banks use a variety of methods to manage risk. They also have to comply with a wide range of regulatory frameworks that are designed to ensure that they operate safely and transparently. At the end of the day, effective risk management is essential to the long-term success of investment banks. By managing risks effectively, investment banks can protect their clients' investments, maintain market stability, and operate in a safe and responsible manner. It is a challenging but vital part of the banking industry, and one that will continue to evolve as financial markets become increasingly complex and interconnected. With that, we come to the end of this video. Thank you for watching.
Just a quick info, guys. If you want to make a career in investment banking, Intellipaat has just the right course for you. Enroll in the advanced certification in the investment banking operations by ENICT Academy, IIT Guwahati. Learn from the industry veterans and academic pioneers and fulfill your dream of becoming an investment banker. Enroll today.